benefits are given in kind. Now, if these benefits are given in kind, there are some that statute has provided how it should be taxed. And there are some that statute has not actually explicitly provided. Now, the ones that statute has not explicitly provided, we will just use the market value. So the ones that statute has not explicitly provided, we will just use the market value. But when it comes to vehicles and when it comes to accommodation, if they are giving you the house or if they are giving you the car, the statute has explicitly stated it. So if you see any other where the statute has not explicitly stated, then you would use the market value of the item that was given to the employee, and then you would add it as a non-cash benefit. However, when it comes to vehicle, fuel, and then a driver, and then when it comes to accommodation, whether with finishing or without finishing, they have provided a way that we should calculate it. All right, so Nicholas, the course has placed it in the group, so you can just click and then join. There are previous files that I placed in, so I don't know if the class can just forward it back to the group, or when I'm done, I'll just forward everything back to the group. All right. So this the fourth schedule, and then it has been amended by the Act of 2023. All right. So this, when you have a driver with a vehicle with fuel. So if you are employed and you are giving a driver a vehicle and then fuel, you will be charged 12.5% of the total cash emolument up to a maximum of 1,500. Up to a maximum of 1,500. Now, with this one, you need to get your total cash emolument right, because if you don't get your total cash emolument right, then it means that you are going to miss, or you're going to get the accommodation and then the motor vehicle wrong. Now, what this is saying is that when you charge 12.5% of the total cash emolument and then it exceeds 1,500, then you cap it at 1,500. Now, usually when it is per month, they will tell you it is per month. However, if there is nothing there, they have to treat it as per year. But usually the law always makes sure that it adds per month or per year, so that it doesn't create any confusion. So usually when we work and we are being paid on a general basis, it is usually per month, per month, per month. However, when we are actually writing someone's tax for the year, it is per year. It is per year. So always, if you see per month, in exam jurors I've seen here, I'll come back to you. When you see per month, usually the questions that are being given, it is per year. So you multiply by 12 and then you put the amount there. You multiply by 12 and then you put the amount there. Yeah, Julius, you understand?
Yes, sir. Please, I want to find out, are you showing any slides?
Yes, please, I'm showing slides. Can anyone else not see my slide?
Yeah, it's not showing over here, so I'm wondering.
Someone else not seeing my slide? Hello, can anyone else see or not see my slide? Hello. Hello, I'm talking to the whole class. Can anyone else see or not see my slide?
So I can see the slide of schedule motor vehicle as amended at 1094/2023. That's what I can see on my screen.
All right, thank you very much. So Julius, I don't know whether it's your network, so you can just try signing out and then signing in and see again. So you can just leave the call and then rejoin the call and see what I can see.
All right, thank you.
So you're welcome. So when it comes to vehicle with the fuel, it is 10%, and then it is capped at 1,250 per month. When it comes to vehicles, it is 5%. So if you are being given a vehicle only, it is 5% of your total cash emolument, capped at 625 per month. And if it is fuel only, it is also 5%, which is capped at 625 per month. Now, when it comes to accommodation, If you are being given accommodation and furnishing, that one is just 10% of your total cash emolument. There is no cap. If it's accommodation only without furnishing, it is 7.5%. If they only furnish your apartment, it is 2.5. And then if they give you a shared accommodation, so if it's a house, but the accommodation is shared. So for example, you have your own bedroom, but you share a hall. So if it is a shared accommodation, and it is just 2.5% of your total cash emolument. Now, last week, someone asked, what if you are given two vehicles? And like I said, it is not explicitly stated. I did some research, and then with some countries like the UK and Canada, it is explicit that they charge based on the number or the vehicle that you use. But in Ghana here, it is not explicit. It is not explicit. So until the law makes it explicit, it will become very difficult. It will become very difficult because even other cases are saying that neither does the administrative, that is the GRA itself, or neither can even the court extend a tax law that does not explicitly say something. However, the argument that I also saw was that we have general rules where it said that you can use the market value of an item if it is not provided in the statute. So if it's not provided in the statute, you can use the market value. However, these are just conjecture. It is not what is in the tax laws. So as of now, these are just information that you should know, that if it is two vehicles, then probably you might have to ask the actual GRA so that you know how to treat it. However, it is not stated in the law. Because one argument is that if the law doesn't say it, then you shouldn't do it. But another argument is saying that the general law is that if it has not been provided by statute, then you should use the market value. So it will mean that if the second vehicle has not been provided by statute, then it means that you should use the market value of the vehicle. However, with that one, it's also something else, because the vehicle is not something that you use only for 1 year. So it becomes a little bit complicated. So until there is an explicit law on that, there will still be this contention. All right. Someone is speaking. Does a person have a question?
Please, which page are we?
The page. Julius cannot still see the slides. I don't know, because the slides is
I can
slide
see
is
that
visible.
this is my first time joining. I don't know the unit.
Yeah, so these are so we are in the third. We are looking at income tax based on employment.
Okay, thank you.
Now, I have the book is a little bit outdated, so they've added additional notes to the book. So you see that when you go to the Google Drive, there is an additional notes to the book. So that is what we are using. However, even with the additional notes, for the past year, there has been a little bit of changes in the rates. Usually when it comes to tax laws, the treatment and the rates are what usually changes. So there's been a little bit of changes. So in my slides, even with the updated notes, you see that some of the rates are a little bit different. Because with the tax, every year we are changing, every year they are adjusting the rates. So you will see a little bit of difference in it. Julius, I'm presenting, but I don't know why you cannot see. All right. So we are going to tax treatment of employer rented accommodation. So when an employer rents accommodation for an employee, the cost of the employer is added to the employee's salary. So this is accommodation. However, the employer is paying your rent for you. The employer giving you your house or a house for you to live in is different from the employer actually paying your rent for you. Giving you your house is different, and paying your rent for you is different. Now, giving you the house is a non-cash benefit, even though it is an accommodation. But if they pay the rent for you, they didn't give you the house, but they are paying your rent for you. So it becomes a cash benefit, which is added to your to the salary. So that's why we have the non-cash aspect and then we have the cash aspect. So this cost includes the rents paid, the repairs and other expenses under the rent agreement minus any amount paid by the employee. So it will depend maybe the employer is paying 100% for you. If the employer is paying 100% for you, then it means that the 100% is added and then it is taxed. Now, if the employer is paying only a percentage and you are paying the percentage, they will deduct the amount that you are paying from the total rent, and it will be left with only the one that the employer is paying for you, and that is the amount that is going to be charged, or that is the amount that is going to remain taxable. Now, if the rent element is applied, the employee's rent payment affects the taxable income. Definitely, it is going to increase the taxable income. Also, if the employee pays rent to the employer, the rent paid is deducted from the rent element, and then the excess is added to the cash emoluments. So either way, if the employer also gives you a house and then you are paying some amount of rent, but the rent that you are paying definitely is a subsidized rent, the excess amount is added to your cash emoluments. So we are saying that any kind of benefit that you are earning. So if you were supposed to rent and you're supposed to pay, let's say, 700 a month, and then you end up paying 500 a month, it means that definitely you are enjoying a benefit of 200 cedis a month, and that 200 cedis is added to your taxable income. Also, if the rent paid by the employee exceeds the rent element, the excess is not deductible from the total cash emolument. Now, if it is the other way around, it is not deductible. So the law is saying that if you are paying less, then it is added and then your tax is going to increase. But if you are paying more than the rent, then you are not allowed to deduct it to reduce your tax element. So this only comes in if you are paying less, and then they want to charge you more. However, if you are paying more than the actual rent, then you are not allowed to deduct. And even generally, if you are being given accommodation by your employer and you are paying more, people even say, why then there's no benefits here? So why would you even go and then rent a building that is charging you more than you should be paying? However, this is just looking at the law. The law is saying that if you are paying more, you are not allowed to deduct it from your cash element. Now, where the rent paid equals the rent element, the element is neutralized without resulting from a nil effect. So if they give you accommodation and you are paying an amount similar or the same as the accommodation, so if they rent an apartment for you and the employer is paying 700 every month, and you end up paying the employer 700 every month for your accommodation, then there is no benefit here. Here, the idea is to tax the benefit that you are enjoying. So if you are paying the exact amount, then you are not enjoying any benefit. So nothing in relation to rent is going to be added to your taxable income to be taxed. Now let's go to loan benefits. Now, usually when it comes to loan benefits, sometimes you would be given a loan by your employer. And then the loan that you'll be giving the loan at a reduced rate compared to the interest that you'll be paying if you are taking it from a bank. So the reduction in the interest that you are enjoying is also a benefit, and that benefit is subject to tax. I take it again. If your employer gives you a loan at a reduced rate, that reduced rate that they are giving you is a benefit, because if generally the rates of the banks is, let's say, 20%, and they've given you a loan for 5%, definitely you are enjoying a 15% benefit on your loan. You are paying 15% less when it comes to the interest that you are paying. So because of that, that becomes a benefit, and that benefit is being taxed. So the loan qualification is nil. That means that your loan doesn't qualify to be taxed. So when this applies, then the loan doesn't qualify to be taxed. So when the loan is from an employer to an employee, two, when the loan does not exceed 12 months, and also if the aggregate loan amount or any similar loan outstanding anytime during the month or the previous month does not exceed 3 months basic salary. So if all of these things apply, then even if you are taking a lesser interest rate or you are paying a lesser interest rate as compared to other people, that benefit is not taxed. So if it is not from the employer to the employee, if it exceeds 12 months, and also if it exceeds 3 months basic salary, then we are saying that you are going to be charged for the benefit. But if it does not qualify for all of these things, that means that if it is from the employer to the employee, if it does not exceed 12 months, and also if it does not exceed 3 months of the basic salary, then you are not charged that benefit. So the qualification is applicable: one, when the loan is from an entity to a member or a manager of the entity, from an employer to the employee. Two, if the loan exceeds 12 months. And three, the aggregate amount exceeds 3 months basic salary. So if any of these applies, then it means that your loan is going to be subject, or the benefit is going to be subject to tax. So always see whether the loan is from the employer to the employee, if the loan does not exceed 12 months, and also when it comes to the amount does not exceed 3 months basic salary. If any of these does not apply, that means that even if one does not apply, then that loan is subject to tax. If one of these does not apply, then that loan is subject to tax. All right, please hold on, I'm coming. Okay, so sorry about that. So as I was saying, if it does not meet any of the three above, then you would have to charge a loan benefit, and then that will be taxed. So how do we tax it? Loan benefit for the year of assessment is quantified as a quarter of the difference between the interest that the employee pays and the interest that would have been paid if the statutory rate applies to the income. So taxable loan benefit is equal to the statutory interest minus the employee's interest divided by 4. So basically, if you want to write it mathematically, it is B minus A divided by 4, which is going to give you the C. The C is the taxable loan interest. So the taxable loan interest is the amount that is going to be added to your emoluments for there to be a taxable income. So A is the amount paid by the employer interest rate. So if the loan is 10,000 and you are paying 5%, 5 times the 10,000 becomes the interest that you are paying. And B is the statutory rate. So if the statutory rate is at 20%, B is going to be 20%. Julius, I've seen your hand, but I'm coming. Hello, sir. Hassan, I can see your hand. I can see multiple hands, but
Please, what you are teaching us, we can't find it in our model. So. Hello.
Sir says he's coming. I beg, hold on. He says he's coming. When he comes back, come and answer you. Okay.
Hassan, I'm saying that I can see your hand. I can see everything, but give me 5 minutes. We are in unit 3. We are in unit 3.
Please, unit 3, section what?
Unit 3, there has been modifications. So if you're using the book, it's not going to apply to what we are doing. If you want to use the book, that is not going to apply. So follow what I'm doing. After, I'm going to send the news to you.
Okay.
All right. Sorry about that. So those who had their hand up, is there any question? Do you have... Hello, those who had their hand up. All right. So let me continue. But I hope you can hear me. Just give me a thumbs up if you can hear me. All right. So when we are calculating the amount to be added as your loan benefit, it is just the statutory interest that you have to pay minus the interest that the employee actually paid divided by 4. And that is the amount that is going to be added. Now, the statutory rate is the Bank of Ghana discount rate, which is the monetary policy rate. You don't need to have it in mind. If this is a question given to you, they are going to give you the rate. You don't have to. This one, it changes from time to time, so you don't have to have this in your mind when you are going to write the taxation exams. If you are being asked a question on loan benefits, they are definitely going to tell you to assume the statutory rate of a percentage, and the percentage that the employee paid was this. They are not going to ask you to memorize everyday statutory rates. Now, use of domestic servants. Use of domestic servants. Now, we have 2 types of domestic servants for taxation purposes. One, we have watchman, garden boy, whose duty is to maintain the property. And then we have stewards, cook, who provide personal benefits. So we have watchmen and garden boy and other people who are supposed to maintain the actual property. And then we have people who provide personal service, like stewards, like cook, people who do personal things for you. Even if you have someone who cleans your shoes, someone who does anything for you personally, then you fall under these services. Now, this group this way because we have some that are taxable and some that are not taxable. So if the property belongs to the employer, then the services for watchman and garden boy is not taxable. However, if the property belongs to the employee, then that is taxable. Now let me explain. If the employer gives you accommodation, the house belongs to the employer and they give it to you, you are already being charged the accommodation allowance that you for the non-cash benefits. But if they give you watchman and garden boy, the idea is that they are not maintaining the property for you, they are maintaining the property for themselves. Because after your employment is done, you will leave the house. So if the house belongs to the employer, and the employer has a security man or a watchman and a garden boy to trim the leaves and to make sure that the lawns are being mowed, if the accommodation belongs to the employer, then they are not doing it because of you. They are doing it because the property belongs to them and they want the property to be protected and they want the property to be kept clean. So if the property belongs to them and they hire these people to maintain the property, then it is not your benefit, it is to their benefit. That is why you are not taxed if the property belongs to the employer. However, if the property belongs to the employee and they are paying watchmen and garden boy and other people, and it means that it is your benefit because the property belongs to the employee. So that is why we split the difference. If the property belongs to the employer, then any protection or any way that the employer is keeping the house clean, even though it benefits you a little bit, the grand benefit goes to the employer because they don't want anything to be destroyed or they don't want anything to be spoiled in the house. So if they are keeping the property clean or they are keeping the property secure, they are keeping the property because of them and not because of you. So generally speaking, it benefits them, even though it benefits you, but generally speaking, it benefits them the most. So if the property is for the employer, then we are saying that if they hire garden boy and watchman, you do not, or the benefit is not charged or you're not taxed for that benefit. All right, Felix.
Yes,
Felix,
sir.
yeah.
I have the first model, not the soft copy. Cold model itself. I don't know the exact page so that I can follow along with you.
I'm saying that follow me with the slides because the course model is a little bit outdated.
The slide is not showing. That's why the slide is not showing as well.
All right, so this is
maybe it's from your there, but some of us we can see the slides. So
the slides are showing. So check your.
it's showing. Maybe it's from your network or is your network or your phone.
But Felix, because these things have been modified a little bit in the book, I cannot show you the exact place that you can follow because even if I show the exact place, what I might be saying will be different from what is in the book. That's why I don't want to give you a page because a lot of things have been modified. So because of that, I am going to stop presenting and try representing to see whether you can see. So that's what I'm going to do. I'm going to stop presenting and then represent
because,
to see whether,
like I said, I also didn't see the slide. I have to open the module, but I was a bit taken away, so I had to just stop.
Yeah. So like I said, yeah, the model has been modified a little bit.
So, sir, that would be appreciative if you could restart the slides for us to see if it will catch up.
All right, so I've restarted it. Hopefully, I'm hoping that everyone can see it now.
Yes, so we got it now. Thank you.
I'm hoping everyone can see it now. All right. You're welcome. So as I'm saying, if you are using domestic servers, and it can be grouped under the fact that they are just using it to keep watch or maintain the property. If the property belongs to the employer, you are not charged that benefit. But if the property belongs to you, then you are charged that benefit. However, when it comes to personal services, it doesn't matter whether the property belongs to the employer or it belongs to the employee, because these are personal services. So if the property belongs to the employer and the cook is cooking for you to eat, whether it belongs to the employer or it belongs to the employee, these personal services are being enjoyed solely by you. The employer doesn't get any benefit when the stewards cook just because it is their property. So if it is for personal services, then we are saying that it doesn't matter My network went off a little bit, but I hope we can hear now. If you can hear, please give me a thumbs up. All right, thank you. So, Nicholas just raised the hand. I don't know whether it was in lieu of the thumbs up or he actually has a question. All right. So, like I'm saying, when it comes to keeping what and maintaining the property, you have to split the difference between whether it belongs to the employer or it doesn't belong to the employer. But if it comes to personal services, that doesn't matter. We just want the fact that if you are enjoying the personal benefit, then you should, or that amount needs to be added and then it needs to be taxed. Now, employment gifts. Now, if you receive a gift, then we are saying that that gift is taxable. Gifts are taxable. So, gifts received in respect of employment, whether in cash or in kind, are taxable. So, if gifts are received because of employment, then we are saying that it is an employment gift. Then that if you wouldn't have received that gift, if not because of your employment, then we are saying that that gift is an employment gift. Now, this includes tips received from the employer or third parties as reward for services rendered. Awards given under incentive schemes such as timekeeping or sales are also subject to tax. Any gift as appreciation for work done is considered as a taxable income. So those who work, when you are tipped, you should record that and that should be taxed. So every gift, every tip that you receive in respect to your, see, Julius is laughing. You are here and you are invading tax. Is it the laws are there, but just because one, we don't know, and two, even if we know, enforcing it will be very difficult. Because recently my uncle sent me to go and buy some stuff, and anytime that the loading boys load the stuff for you, you would have to, tip them a little bit because they've done something for you. Those things just go straight into their pockets. Those things are not subject to tax. I'm sure probably their monthly salary will be subject to tax, but the tips, when they load the things, for example, this heavy stuff, if they load it into the bags for you and then you tip them, all of those things just go straight into their pockets. Now, those things under the law are subject to tax, but because of enforcement problems, we do not actually see that. So, tips are subject to tax. Even outside employment, if you are given a gift, any kind of gift that you are given is subject to tax. If you are given a gift, those gifts are subject to tax. However, like I said, enforcement issues can be a problem. So if you are given a gift, if it is under employment, what you basically have to do is that you have to take the amount of the gift, add it to your employment amount, and then it will be subject to the taxable. Fidel.
Sir, concerning the
Yeah.
employment gift issue, is it the enforcement that is not being done or the declaration that is not being done for it to be enforced?
You see, I was even trying to do a study on that, but I didn't find the time. I want to check how many people were paying their gift tax and why they were paying or why they were not paying. Now, first of all, no one likes to pay tax. That is it. No one likes to pay tax. So if you do not enforce me and don't get me to pay the tax, it becomes very difficult for me to pay the tax. Now, elsewhere, for example, in Spain and in England, we see it when it comes to footballers. No matter what, even if you evade, at the end, they will come back and get you. So because at the end, they will come back and get you, you definitely would have to pay your tax. So if you are not paying and no one minds, that doesn't mean that, for example, they are just ignoring you. You remember Messi's taxation issue, the boys who follow football. You realize that a lot of players are sent to court just because they evade tax. Now, these taxes are there. So according to them, ignorance of the law is not excuse, even if it applies generally. So just because you are not aware of the law doesn't mean that you can just evade the tax. So if you don't pay the tax, they'll just compound all the taxes that you're supposed to pay. And at the end, they'll definitely take their tax. But in Ghana here, education is scanty. Even if not for this taxation, most of us wouldn't know that gifts are taxed. So I think from your question, I can say that education is one. And even after education, who is going to take the tax? Because like the tips that we give them, we just give them out of pocket. So how are you even going to track the amount or the tips that they receive in order for you to tax them? So
So that is
education
exactly
one,
what
and
I'm trying
also,
to ask.
yeah.
That is exactly what I'm trying to
So
say. If you give me a tip and I don't declare that at the end of the day, this so and so person came and gave me a tip, how would the employer know that somebody has given me a tip that it should be taxed? That is what exactly I'm trying to say.
Yes. And even if the employer knows, you can tell the employer that, oh, Nescafe is so the account, or are you going to add this amount for me to be taxed? So I think, yeah, the enforcement is a little bit of a problem when it comes to the gifts. That is why we don't tax it, but it is supposed to be taxed. We are learning the law. So the law says it is supposed to be taxed. So you that you are learning, if you end up being accountants in your firms, anytime that there's a gift, you can just add it to. If you are doing payroll, you can just add it and then be taxed. They may not like you, but you are following the law. Now, another thing is that I've not been to the US before. So everything I'm saying concerning the US is something I've read or something from a movie. In the US, when you buy something, they've made tipping kind of their culture. People usually tip. And when you tip, it is part of the screen. So for example, they enter everything for you and the list is $50. $50 after they will ask you whether you want to tip and how much you want to tip, whether you want to tip as a percentage or whether you want to tip as a dollar amount. So when you enter, let's say $10 as a tip, the system has already captured that $10 as a tip. So if they have a tax on that tip, then it means that that amount has been captured and then the system automatically is going to tax it before you get even the amount back. But in Ghana here, like I said, education and enforcement, even technologically, we don't have these things. So if you are not God-fearing enough to declare it, then it means that gifts in relation to these endeavors are not taxed. All right. But have it in mind that gifts are supposed to be taxed. And when it comes here, the law has made it a little bit flexible. That if the gifts are in relation to employment, then we are saying that you have to add it to your taxable income in relation to employment. But if they are in relation to other things, then you can just, it is just subject to a 25% tax. When we get there, we are going to look at all of that. But if it is in relation to employment, then we are saying that add it to your taxable amount and then you tax it on the graduated scale. I'm going to show the graduated scale shortly. However, I think I sent a graduated scale to the group. As of last year, before the year ended, it was updated. So what I'm going to show you will be a little bit different. The amount has been updated. So what I'm going to show you, the amounts are going to be different. All right. So tax treatment of passage payment for the first employment and termination. Now, if you are being employed for the first time, they give you some amount. Sometimes they may give you some relocation fee and those things. And also, if there is termination, they can give you some severance package. So how are we going to treat this? So passage payment for an individual's first employment or termination is tax exempt. If the payment includes family members, the portion covering them is taxable. So for example, you are in Tamale and then your work is bringing you to Accra. Now, if the work bringing you to Accra, they are giving you a relocation fee and then also other fees for inconvenience and other fees. If they add all of them, and let's say they are giving you 30,000 personally, that 30,000 is not going to be taxable. However, if you have dependents and they say that because of these, yeah, we'll be coming to bonuses soon. Don't worry. Daniel will be coming to bonuses soon. Now, if these dependents, because of the dependents that you have, so for example, you have a wife, you have a kid, and you are bringing your wife and kid with you, and because of that, they make the amount 50,000. Then we are saying that the 30,000 is not taxable. However, the 20,000 additional one that they are giving because of your family members will be taxable. So in relation to you personally, if you are your first employment and termination, if there's any amount given to you personally, it is not taxable. However, if they are giving it to another person because they are moving with you, then that aspect becomes taxable. Also, so cash payments for family members are added to employee cash emoluments and they are taxed. If the employer buys tickets for the employee and the family portion of the family's portion is taxable, is a taxable benefit in kind. Like I said, if you are moving from Tamale and then they are booking a flight for you or they are giving you tickets for a bus or something, if it is for you personally, it is not taxable. But any additional family member that you are bringing along, that kind of benefit is taxed. That kind of benefit is taxed. Now, treatment of employer provided accommodation. So, employer provided accommodation is generally taxed as a benefit in kind, the schedule that we looked at the top there. Now, accommodation provided at a field of site for timber mining, construction, farming, and petroleum are exempt. You remember that I said that if it is a site job and you are given accommodation on the site, then that accommodation is not taxed. However, accommodation elsewhere is taxed. So when it comes to this accommodation, we are saying that if they give you accommodation off the site, that one is taxed. But if you are a miner, if you work in petroleum drilling, if you are into farming, and then because of the farming, they give you a house on the site, then that particular housing on the site is not taxable. That is not applicable to the accommodation schedule. Now, exempt accommodation does not apply to administrative head office. They only apply to the site that you are working on. So is it that some companies, they have their site and then they have where their offices are. Sometimes their sites and the office can be at one place, but because maybe because of the noise that we're making, if you are into timber, they are going to fell trees and the trees are going to make noise. So definitely their site is going to be a different place and then their head office is going to be a different place. So if the accommodation is in relation to a house or accommodation closer to their head office, then we are saying that that is not part of the exemption. It only applies if it is on the site and your accommodation is on the site. That accommodation allowance is not subject to tax. So residential accommodation in metropolitan, municipal, and district capitals is taxable if field operations are not conducted there. So what they want to have or what they want you to know is that if it is not where the site is, where they are doing the field operations, any accommodation elsewhere is taxed. Even if the accommodation is closer to your administrative office, it is still taxed. It is only non-taxable or it's only exempt if it is on the site where the field work is being done. Also, if an employer provides cash payment for rent or accommodation, they are taxable as part of the employee's income. So if they are given in kind, that is the accommodation in kind, you use the schedule, and if they are giving you money for you to use the money to rent, then that amount is added to your cash benefit, and then that is also subject to tax. So what this basically is saying is that accommodation allowance is taxed, whether it is in kind or it is in cash. However, if the accommodation is on the site where you are doing the job could include timber, mining, construction, farming, anything that requires on-site. If it is like that, then that one is exempt from taxation. Now, we look at employment income that are exempt. Employment income that are exempt. So these employment incomes are exempt from taxation. One, we have the president's salary, allowance, pension, and gratuities. Every amount that we are paying to the president is not taxable. However, it is in relation to his presidency. Have this in mind. Any amount that we are paying to the president in relation to his presidency is not taxable. So, for example, if the president has a company, the company is going to pay tax. Definitely, the company is even a simple legal entity. But if the president is having any other income from not being a president, that one is subject to tax. However, if we give the president an amount in relation to his presidency, those amounts are not taxable. Also, pensions and gratuities related to personal injury or death compensations, these are not taxable. Also, I think we've even gone through this, so let me just go through it. Scholarship and bursaries and others, education endowments, not taxable. Individual incomes with diplomatic privilege or working under ratified technical service is also non-exempt. Now, foreign service allowance for Ghanaian diplomats and certain temporary government employees are also tax-free. So, for example, Ghanaian diplomats who have been given to work outside Ghana, all of these diplomats are tax exempt. Also, interest from residential financial institution and government bonds, as well as earnings from approved units, trust schemes are also exempt. So, if you invest in any or you buy a treasury bill from any government institutions, the treasury bill that we receive are not taxed, or the interest that you received are not taxable. So, interest from residential financial institutions and government bonds, when you buy these bonds or when you buy these kind of investments from these Ghanaian institutions and they pay you interest, those interests are not taxable. That means that they are tax exempt. Now, when it comes to the employment income, they give you certain allowances that can be deductible. Apart from the relief that they give you certain amount that can be deductible. So one, we have donations and contributions to a worthwhile cause. So if you donate to a charity for a worthwhile cause, that amount is subject to tax to be tax deductible. Also, charitable organizations that meet the requirements also under Section 97 also qualify for deductions. All of these are talking about these worthwhile courses. Now, scholarship schemes for academic, technical, and professional studies are also eligible. So if you have a charity and you are part of the people who contribute an amount into the charity to pay other people's school fees for either academic, technical, or professional studies, those amounts are tax deductible. Also, contributions to rural and urban development are also deducted. Donations towards sports development and promotion are tax deductible, and other courses that are approved by the Commissioner General are also deductible. So all of these donations are allowed to be deducted. So if you receive your salary and at the end of every month you invest in a girl child education scheme, if you are investing in a girl child education scheme, that amount that you are paying to the girl child education scheme is allowed to be deducted so that your taxable income is going to be reduced. So any donation to a worthwhile cause, being it academic, being it something that helps the society, being it something that builds rural and urban development, all of these donations are allowable deductions. So, payments made to employees on a non-discretionary basis. Now, free or subsidized meals in staff canteens are tax exempt if available to all employees. Now, when we say discriminatory basis, that means that there are some people that when they receive some benefits, other people do not receive it. So it is kind of discriminatory in some basis. That means that the word here, I don't use the discriminatory, or I don't say they are discriminating, but they are given to other people based on their status, and they are not given to other people. Now, if they are given to other people and not everybody, that should be taxed. But if everybody is enjoying the meal or everybody is enjoying that benefit, then we are saying that that is tax exempt. So, for example, when you go to a business and then they have free or subsidized staff canteens, so everybody eats for free in the company, then we are saying that that amount is not taxable. However, if only the management are giving free meals and then the other people would have to buy the meals themselves, then that amount is taxable. So we are saying that if it does not discriminate anybody in the company, if everybody is enjoying the free meal, then everyone is enjoying it. So because everyone is enjoying it, then that amount is not taxable. So this one includes one, free meals. So if everybody is being given a free meal, a subsidized meal, it is tax exempt. Also, mobile phone usage is exempt when no line exists and is available to all employees. So mobile phone usage is also exempt where they don't use any landline, but they are being given mobile phones and everyone is enjoying the mobile phone, or maybe they're even giving an amount for call credits and everyone is being given an amount. And we are saying that that amount is tax exempt. Also, employer provided bus services for staff. If everyone just has access to the bus services, there are some companies that they would give you a bus service. That means that in the morning you just stand in front of your house, and then in the morning you just stand in front of your house, and then the bus comes to pick you up. That one is also not taxable, even though you are enjoying the benefits. Because everyone enjoys it, it is not taxable. Also, annual staff parties, recreational facilities, and welfare counseling are also exempt. So if you have a staff party, the staff party is not taxed. They're not saying that because you enjoyed at the party, it should be taxed. No. Also, recreational facilities, we have some companies that have a gym, some companies that have a pool. So, for example, after work, you can just go to the gym and then work out. After, you just take a shower and go home. So, some companies also provide these services. So if they have these recreational facilities, they are not being taxed for interest. Even though it is benefiting them in that way, they are not being taxed. Also, if there's a welfare counseling service, mind you, if you were going to an external counselor or someone to counsel you based on the problem that you have, definitely you would have paid something. So if the firm has it, then it's that amount is going to be enjoyed by you. But we are saying that if it's in relation to welfare counseling services, then we are saying that those amounts are tax exempt. Also, health screening, eye test, and parking facilities for all staff are also tax free. So any of these, if all employees enjoy all of these things in a non-discriminatory basis, then we are saying that those things are not supposed to be taxed. But if some people are enjoying, and some people are not enjoying, then those ones may be subject to taxation. Now, the one who asked the overtime question, this is where it comes in. So, final tax on overtime payment. Now, overtime payment to qualifying junior employees are subject to specific tax rates. You remember the junior employees that we're talking about? The junior employees, where I said that it was 18,000, but it has been increased to 96,000. Let me verify. So at first, it is 18,000, but now it has been to 96,000 or so. Yeah. Is what I'm coming. Yes, so it is 9,600. So it's supposed to be 96,000. So at first, a junior qualifying employee is someone who earns 9,600. But now it is someone who earns 18,000. So if you earn 18,000 or more, we are saying that you are not a junior qualifying employee. But if it does not exceed 18,000, then you are a junior qualifying employee. So let's get back to the overtime payment. Now, if the overtime payment is less than 50% of your basic salary, it is taxed at 5%. However, if overtime payment exceeds 50% of the basic salary, then the excess is taxed at 10%. That means that if you are a junior employee, that means if you earn 18,000 or less, if you're a junior employee who earns 18,000 or less, then that will mean that if your overtime payment is more than 50% of your basic salary, you are being taxed 10%. But if it is being less than, you are taxed 5%. So it means that if they check and it is, let's say 75% of your basic salary, the first 50% is being charged as the first 50% is being taxed at 5%. However, the excess 25% will be taxed at 10%. So we are saying that there's a 50% rule. The first 50% is taxed at 5%. If there is no excess, then it means that your amount does not exceed 50%. But if there's an excess, then the excess is going to be taxed at 10,000. That is what they are saying. So if we have 18,000, the 18,000 is per year. So 18,000 that you have divided by 12, then it means that someone who earns someone who earns 18,000 divided by 12. So someone who earns 1,500 is a junior employee. That means that if you earn more than 1,500, you are not a qualifying junior employee. Now, in all other cases, the entire overtime payment is added to the income and taxed at the graduated scale. So if you are not a junior staff and you earn more than that amount, then we are saying that the whole overtime is added and then it is being, yeah, okay. So Stephen, I'll send you the slides after the class, don't worry. So for all other people, we are saying that your amount is being added and then it is being taxed on the graduated scale. Now, mind you, on the graduated scale, it moves up to 35%. It moves up. So it means that you'll be taxed higher if you are not a qualifying junior staff employee. Now, bonuses. So if the bonus does not exceed 15%, then it is taxed at 5%. If the total bonus exceeds 15%, then the excess is added to the employment income. So the first 15% is taxed at 5%, and then the excess is now added, and then it is taxed on the graduated scale. So the excess amount is then taxed according to the first schedule, that's the graduated tax scale. So basically, we are saying that if it exceeds 50, if it does not exceed 15%, then only that 15% is taxed at 5% for the bonus. But when it comes to these more than 15%, then the amount left, it will just be added to the taxable income and it will be taxed on a graduated scale. Now, the difference between overtime and bonus are kind of different. Overtime is something that you've worked for. So any time that you work over the amount of hours that you are supposed to work and you are being paid an amount, that is overtime. A bonus may be as a result of a collaboration for the whole company. So, for example, if all done well and then they are giving you some kind of bonus. So bonus is being given in that way. So if it's a bonus, then it's 15%, and then if it's more than 15%, it is added to your employment income to be taxed. So payment to casual workers. Now, here we have casual workers and we have temporary workers. Some workers are casual and some workers are temporary. Now, we will go to the difference, but let's see the taxation that we tax on casual workers. Now, if you are a casual worker, your tax is 5% and it shall be treated as the final tax. So if you're a casual worker working for a company, then it means that your final taxation, they'll just charge 5% and then that is it, you don't pay any tax again. So now let's move on. With a temporary worker is just like any other person, and then they are taxed based on the graduated tax scale. So it means that we have to now know the difference between a casual worker and a temporary worker, because they are both people who do not work full time for the company, a casual worker and then a temporary worker. However, one is being taxed at 5% and then that is it, and then the other person is being taxed on a graduated tax scale. So we need to know the difference between a casual worker and then a temporary worker. So a temporary worker is a worker who is employed for a continuous period of not less than 1 month and is not permanent or employed for the work that is seasonal in nature. And then when it comes to a casual worker is engaged on a work which is seasonal or intermittent and not for a continuous period of more than 6 months, and whose remuneration is calculated on a daily basis. So a temporary worker is someone who is employed for a continuous period, but it is less than a month. So of not less than 1 month, that means that even though he's being employed and it's not permanent, we are saying that the period that he's being working in is not less than 1 month. So the period that he's working is not less than 1 month. And his work is not seasonal in nature. But casual workers works are seasonal in nature. So, for example, if you have a farm, and let's say your farm produces fruit twice a year. So, if the first time your your farm produces fruit, you employ people to come and work just to come and bag it and then what? Just transport it for you. Now, if your work is seasonal, so for the first time they come, they work, and after they go away. And the second time that your farm produces fruit, they come again and then what? They work. Now, if that is the case, then we are saying that that person is a casual worker because the work is seasonal in nature. And also, when they come, you calculate the amount that you are paying them on a daily basis. That means that every day that they come, you take. Every day that they come, you take. And then at the end of the period, you add everything and then what? You pay to them. That becomes a casual worker. Also, the duration in which they work is no more than 12 months. It's not more than 6 months. That means that even though it is seasonal in nature, it will be a month or two. When they are finished with their work, they go away. So that makes them a casual worker. And a casual worker, you just withhold 5% and then you pay to the government and they give the 95% to them. But with a temporary worker, even his work is more than 1 month, but it is not a temporary person. So anyone who works at a place and he's working for more than a month, and it's not a permanent person, Daniel, I'm coming, and it's not a permanent person, and his work is not seasonal in nature, then a person becomes a temporary worker. Yeah, Daniel.
Please, sir. I want to find out something. Assuming I attend a workshop and they pay me T&T, or maybe the feeding they have to feed me for that particular workshop or the accommodation. Is it taxable or it is not taxable? Thank you, sir.
You are attending a workshop.
Yes.
Is it you are attending a workshop?
Yes,
So
sir.
let's look at that. Usually, maybe the workshop is for the entire company. The workshop is professional. It's for professional development. So if you go and they give you
Yes.
like everyone accommodation at the place, then it's not taxable.
Mm.
It's a workshop for the entire company.
Okay.
Everyone is going to enjoy it. Yeah.
Okay.
All right. So that's the
Thank you,
difference
sir.
between. All right. Thank you. You're welcome. So that's the difference between a temporary worker and a casual worker. A temporary worker and a casual worker. So one key distinction is that the temporary worker works work is not seasonal, but the casual worker's work is seasonal. And another distinction is that the casual worker's amount is calculated on a daily basis. So every day that he comes, you take. If he doesn't come, it doesn't end for that day. So that's the difference between the casual worker and the temporary worker. Now, personal tax reliefs. Personal tax reliefs. Before you are given your taxable amount, before you get your actual taxable amount, these are reliefs that must be deducted from your salary before your amount is given to you. Now, mind you, these reliefs, some are automatic and some you need to apply to them. So, if you are married and your spouse is dependent on you, then you get a relief of 1,200 for the year. You get a relief of 1,200 for the year. So if you are married and your spouse depends on you, you get a relief of 1,200 for the year. Also, if you yourself you are disabled, then it is 25%. That means that you only be charged tax on the 75% left. So you enjoy 25%. Julius.
Yes, sir. A question, please.
Julius, hand is up.
So, yes, sir. A question. So, in the other part of our world, we hear and read that there are some tax. I've forgotten the term, but at the end of a year, you can file for the taxes that you've paid, and then the government would pay you back some amount. I want to ask Ghana, do we have same?
Yeah, we have self-assessment. So you see, Ghana here, it is work. So in the US, at the end of the year, they do the assessment and then they go and take their refunds. But in Ghana here, most of us don't care. So for example, I pay taxes every month. So if I pay taxes every month, I will list all my basic salary and everything. And then I will just write the amount that I've been taxed for the whole year. But let's say whilst I'm being taxed, I made some contributions towards some charity, and those charities were not deducted by my workplace. So if because of that, if they didn't deduct it, then I can now claim the exemption and then come and tell them that those were not deducted. So that means that I have been taxed more than I am supposed to be taxed. So because of that, I can go and claim a refund. But mind you, if you are doing that, Ghana here, some people have side jobs. Some people have side jobs. So let's say you have other side jobs that you were not also taxed. So if you are doing your assessment, then it means that you bring all the tax that has been withheld and all those that you've not paid the tax on. Then after you said, okay, so I was also involved in some casual works and some works that I've been doing. So for example, you are an electrician and then you work for a company. You go and then you do this wiring for houses and then they pay the company. At the end of the year, they pay you. But you yourself as an electrician, when you come home in your area or during the weekends, you do some small jobs for other people and then you get paid. So those amounts are also supposed to be added, and then you said, okay, so you've been taxed for this, but you have not been taxed for this. So the government should now tax you on this. Now, if after all and then so when you bring the amount that you've been taxed on, the amount that you've not been taxed on, and when you think there has been an overcharge. So after that, all the three are being compared. So if all the three are being compared and they realize that you need to top up your tax, then you will pay. But if they realize that you've been charged more tax than you're supposed to pay, then they will refund your money for you. But Ghana here, one, education is one, and two, people are afraid that definitely they've been undertaxed because they know the system and they know that they've definitely been undertaxed. So no one just goes and then does the self-assessment. Because we know that definitely people have side jobs that are not being taxed. One example that I usually use is that there are some teachers that they sell Indomie at night. They go to work, when they come back, they come and sell Indomie. Now, definitely their Indomie is not being taxed and they get more money. I'm not saying they get more money than their actual job, but they get money from the Indomie that they sell. So if actually they are doing assessment, then they would have to bring the amount that they earn from the Indomie there, and then they have to be taxed on it. No, so because of they are afraid that they are even earning more than they are being taxed, they don't even do their self-assessment. But genuinely, if you do your self-assessment and you've been overcharged, there will be a refund. All right. So when it comes to personal reliefs, you're welcome. So when it comes to personal reliefs, one, we have the marginal or automatic. That means that if you earn below a certain amount, you are not being charged tax. If you earn below a certain amount, you are not being charged tax. So this is the marginal amount. It is automatic. No matter who you are, it is automatic for everybody. If you earn more than that, they will just deduct that amount and then they will tax the rest. If you earn less than that, then we are saying that you will not pay tax. So the amount is 5,880. I think as our last date was 4,000 and something. But the marginal has been increased to 5,880. That I think that's about 490 cedis. So if you work and per month you earn less than 490, or I think the amount is 490 something. So if you earn less than 490 something, then we are saying that you are not subject to tax. This actually makes sense, because why should we tax people who are earning less? Just imagine someone who earns less than 500 cedis and you want to tax the person. So this is a marginal, and this is automatically built into the system. That if you earn less than 490 point something, if you earn more than, you let's make it a flat amount of 490. So if you earn less than 490 cedis, then you are not being taxed. So if you are a worker actually, let's say some cleaners who work for this private organization and they are being paid this amount, if they earn less than 490, at the end of the year, they are not supposed to be charged tax because of the amount that they tax. So this is how this progressive tax that we discussed, this is how the progressive tax comes into play. So if somebody earns more, the person is not supposed to be taxed. So if you earn as little as less than 490 cedis, the marginal is automatic and it is built in the net. It is saying that if you earn less than that amount, you are not supposed to be charged any sort of tax. Also, if you are married and your spouse depends on you, you have a relief of 1,002. Now, this relief, you have to put it in your head. As for these ones, you have to put it in your head. Also, if you are disabled in any way, you are being allowed to take 25% off your accessible income. That means that they are giving you a benefit just because you are disabled. So definitely we know that disabled people have some kind of, people who are not disabled have advantages of people who are not disabled. So to encourage them or to even make them cater for other things, because definitely for a disabled person, they might spend more on the things that they do as compared to someone who is not disabled. So because of that, they are given a relief of 25%. Also, if you yourself, you are old and above 60 years. So if you yourself, you are 60 years and you are working, there is a relief of 1,500. So if you are 60 years and above and you are still working, you get a relief of 1,500. Also, child education relief. Now, if you have a child and you are paying school fees for them, it is 600 cedis per child, maximum of 3 children. So if you have 4 children, you cannot claim it. It is a maximum of 3 children. If you have 1 child, 600. If you have 2 children, 1,002. If you have 3 children, 1,008. However, if you have more than 3 children, it still remains at 1,008. Now, we also have age-dependent relief. That means that if someone who is more than 60 years is dependent on you, you have a relief of 1,000 cedis per dependent. Now, usually these people are usually our parents or people who have taken care of us. So, for example, if you are taking care of your mother and your father and they are more than 60 years old, you can claim an age dependence relief for them because you are the one taking care of them. And that relief is 1,000, maximum dependence of what? 2. So if you are the same person taking care of your mother and your father, you get a dependence allowance of 2,000. Mind you, you cannot claim and another person cannot claim. So you have to establish the person who's actually taking care of your parents, and that person is the one who's going to take the relief. Yeah, Julius. I think there's another person. Yeah, Daniel.
Yes, sir. Please,
Daniel.
the education relief. This thing working in Ghana? And then the other
working.
one to the point. Is it applying to some workers or all workers?
All workers. So you see, your accountant, you need to your payroll accountant. If you get into the work, sometimes with this advance and with this employment that are very, very, very strict and everything, they ask whether you are married, whether you have any children who depend on you, but whether your spouse is married, sorry, whether your spouse is working, whether you have children. So all the boxes that you take that when you are filling a form, it also applies to taxation. So if you are working and you realize that all of these things, so for example, at this moment, if you are an employee with someone, you have to provide evidence of all of these things and then you would enjoy it. If you're able to provide evidence that the marginal one is automatic, but the marriage and responsibility allowance, if you are able to prove that your spouse is dependent on you, sometimes your spouse is working, but the work that they are doing doesn't generate enough amounts. So if you can prove that your spouse is dependent on you, then you get 1,002. If definitely with the disability, it will be showing, so that one you will get it. If you can prove that you definitely none of us are more than 60 years, but if we get there, or let me even use when we are fortunate to get to 60 years and we are still working, we will still have a relief of 1,500. If you have children, they are taking care of their education, then you get this relief up to 3 children. Also, if your parents are depending on you, you are the one taking care of your parents, you get 1,000. And then at the training, I didn't mention the training, but if you also go for a training, you are also allowed a deduction of 2,000. Yeah, we have Kweku. Kweku, your hand is up. You can unmute and speak. Kweku, your hand is up. You can unmute and speak. All right. So probably it's a mistake.
So
So
please,
I'm going
please
to
sir,
leave
can
it.
I say something?
Yes,
Can I
please.
say something, sir? So
Yes,
that
please.
I'm still on the education, I'm still on the child education relief. In case the government is not honoring it or the organization is not honoring it, how do you lay a complaint or how do you go about to claim that child education relief system?
So the child education relief, your children are there. There's proof that they are your children. There's proof that they are going to school. So you just have to present it to your accountant, and your accountant will apply for the relief. So if your accountant applies for that relief, anytime that your pay comes, it is going to be deducted.
Okay. Okay. Thank you.
Jamil, you're welcome. Jamila, your hand is up. If you want to talk, unmute and speak. All right. So let's move on. If Jamila is able to figure it out, then we will continue. Now we have upfront reliefs. Jamila, are you speaking now? All right. So we have upfront reliefs. So if you satisfy all this one, then you would be given a relief upfront. So dependent of staff, we have children education, disability, and the age. If you are just able to prove it, you will be given the relief. Sometimes they will not ask you, but you are the one. If you know the laws, you are the one. That's why we are all learning. So if you know the laws, you can just go to your accountant and tell your accountant that you've been paying taxes without certain reliefs. So you like to what, apply for this reliefs. You give them evidence and then they'll follow through. And then now on a monthly basis, anytime that it comes, you will be granted this relief. Now deductions. Now there's a difference between reliefs and deductions. Reliefs, even though they are all being deducted, reliefs are being given to you because you do other things. So because of the circumstance that you find yourself in, because of extra spending that you do, they give you the fact that you can get a relief based on that. Now, a deduction is just an amount that you are allowed to reduce your taxable income by. So we do a lot of expenses, but the government is saying that some expenses must be deducted in order to reduce your taxable income because of the nature of the expenses. So, for example, if there's a mortgage interest, a mortgage is where you refinance your house and then you use it for a loan. So, if you take a mortgage on your house, if you take a mortgage for your house, we are saying that the interest that you pay is deductible. Then they can deduct the interest from your amount that you are paying. Also, SNET contribution. If you contribute SNET, the SNET that you contribute is deducted. Jamila, do you want to speak?
Yes, hello. Please, I wanted to remind my colleagues that they can get the release forms at the Ghana Revenue Authority. The release forms are always there. They can get them and then fill them from there.
All right, thank you very much. I think even now that everything is online, I've not checked on the relief forms, but now with the gift tax, there's a form, the company, like a lot of forms are present online, but I've not checked on the reliefs. So if you like, I can even check whether it is online. There are a lot of forms in relation to taxations online, but specifically, I've not checked on the relief forms. Specifically, I've not checked on the relief form, but definitely, if it is there, you can just download it, print it, and then fill it and then present it. All right. So, like I was saying, there are some deductions that are being allowed. So, if you have a mortgage, your interest is being deducted. If you contribute SNET, the SNET amount is being deducted. Also, if there is a voluntary contribution of pension, that one there's a cap. But some people outside their SNET contribution, they contribute to other forms of pension schemes. So when it comes to those forms of pension schemes, we are being allowed a deduction. However, it is allowed up to 16.5. We'll get there, but it is being allowed up to 16.5 cap. That means that if you make any contributions to any other pensions that is more than that, the cap is 16.5. The rest, they will not allow you to deduct it from it. Also, you've already treated donations from worthwhile causes. So all of these are deducted from your income tax, or sorry, from your income to arrive at your taxable income, so that you'll be paying less tax because of the nature of that particular expense. So let's now go to the retirement fund. Now, like I already mentioned, with SNET and other forms of contributions, they are tax exempt. But have it in mind that the employer pays 13% and you pay 5.5%. Now, the employer paying the 13% for you, that one, even though it's a benefit, it is not added. And you going ahead to pay the 5.5, that 5.5 becomes a deductible for you. So in the work, you'll be asked to just deduct what 5.5%. The 13% from the employee is a benefit, and they are not even adding that one. That one don't add it. So, and also, because you are not the one paying the 13%, the amount that you are going to be deducting is not a 13%. Because the 13%, if they wanted to treat it as a benefit, they would have added it to your actual benefit and then taxed you on it. But they are saying that because it is a self contribution, it is a benefit, but it is not be taxed. And in addition, your 5.5 that you are also paying will be a deductible. So in the assessment of the income, just ignore the 13% and just add the 5. And just bring the 5.5 as a deductible. That one that you are paying, they are saying that because it is a contribution towards your pension, you can deduct it and it is going to lower your tax that you are going to pay. So now the 5.5 contribution made by the employee is tax exempt. So if you pay 5%, 5.5%, it is exempt. Also, like I said, other voluntary contributions up to 16.5. So if you are contributing to other pension schemes up to 16.5%, that is the amount that you are going to be exempt. If you are paying more than 16.5, you are not going to be exempt. Now, you also have employer contribution to retirement funds. Like I already mentioned, the 13% that they are paying. Now, employer contributions to retirement funds are tax deductible if included in the employee taxable income. This ensures that retirement savings contributions are accounted for tax calculations. Now, withdrawals from provident funds are subject to taxation under specific regulations. Now, according to the regulation 25, withdrawals from provident funds attract a final tax of 15%. So if it's a provident fund that has been set up for you, the withdrawal that you are withdrawing is going to be 15%. Now, this tax applies to contributions made under the National Pensions Act. So if you want to make a withdrawal from your provident fund, then that is going to attract a tax of 15%. Now, the pay as you earn, everything that we've been talking about is the pay as you earn system. So as you are earning, you are paying. We don't wait to the end of the year before we deduct your tax. So on a monthly basis, as you are earning, we are taking the tax from you. If for examination purposes, when we are calculating it, we usually calculate it on a yearly basis. But in actual fact, we deduct every month. We deduct every month. All right. So if you are being asked, usually the question is yearly, but because some of the percentages or because some of the amounts are monthly and yearly, you need to adjust them. Sometimes, even though the common practice is yearly, you may be asked to prepare the taxation for only a month. So if it's a month, then it means that the monthly amount will not be adjusted. However, the yearly amount must be divided by 12 and then adjusted. But if it's the normal practice that you are going to prepare it for the year, then you're preparing it for the year. The yearly amount remains the same, but the figures that you see per month there must be multiplied by 12 to get the month to get the yearly amount. So let's just go through this because everything we're talking about is the pay-as-you-earn system. So pay-as-you-earn system, withholding system, is where employers deduct income tax from employee salaries and remit it to the TRA. Employers must pay they deducted tax by 15th of the following month. So when they deduct by the next month, the middle of the next month, they have to make sure that those taxes have been paid to the government. And the benefit is that the pay-as-you-earn system improves the government's cash flow by collecting taxes throughout the year. It also reduces bad debt because before the employee even receives the tax, the amount has already been deducted. So it reduces the fact that there will be bad debt from this pay-as-you-earn taxation. Also, employees benefit by paying tax in smaller monthly amounts rather than paying a large tax at the end. Yeah, your tax is deducted before it comes to you. So when your money comes to you, you know that you don't owe the government any tax. But just imagine you are being paid the full amount, and then at the end of the year, you are being asked to come and pay the tax. Probably you have even spent the amount that it may be subject to tax. So it even helps the employees themselves to the fact that their taxes are automatically deducted in smaller amounts. Then at the end of the year, they don't have to find new money to come and pay their taxes. Also, the system ensures predictability of tax revenues, aiding government to budget in budgeting and expenditure planning. So if the government knows the amount of people who are employed and the amount that they are paying, you know that at least at the end of every month, there's the amount of tax revenue that they are going to receive. And it helps them in budgeting and expenditure planning. Now, let's go to the tax rates. The tax rate. Now, the tax rates, the one I sent you, I told like it was 4,000 something for the first one, but it has been modified. As at December 2025, this is the new tax rate. So if you earn first 5,880, you will not pay tax. 880, you are not going to pay tax. Like I said, these are people who are considered as people whose amounts are not enough. Now, mind this, this is a yearly amount. After we'll be going to the monthly amount. So I'll be showing this to you. So if you earn less than this amount, or even exactly this amount, you don't pay tax for the whole year. Now, the next 1,320 is being taxed at 5%, and then the amount is on 66 cedis. The next 1,560 is taxed at 10%. The next 38,000 is taxed at 70.5%. The next 192,000 is taxed at 25%. And the next 366,240 is taxed at 30%. Now, when you add all of this together, you get 605,000. So if you earn more than 605,000, then the excess is charged at what? 35%. Now, definitely 600,000 is a lot of money. When we talk about 600,000, we're talking about 6 billion. Old Ghana cedis. So if you earn more than 6 billion in a year, then we are saying that the excess that you are earning is subject to a tax of what? 35%. Now let's go to the monthly breakdown. So anytime that you receive your monthly salary, this is the amount that they usually charge from it. So the first 490 cedis, there are some decimals, but the decimals have been taken off. Now the first 490 cedis is being charged at 0. That means that in Ghana here, if you are someone who earns less than 490 cedis, you are not taxed. Now the next 110 cedis is charged at 5%. The next 130 cedis is charged at 10%. And the next 31,667 is charged at 17.5%. Now these calculations are 2 decimal places. Usually when you're in exams and they tell you to approximate it to 4 decimal places, you might see a little bit of difference. All right. Now the next 16,000 is charged at 25%. And the next 30,520 is charged at 30%. Now the 605,000 that you saw in the yearly amount, when you divide by 12, you are getting 50,000. So that means that if your salary exceeds 50,416, then we are saying that you are going to pay 35% per month. So this is the monthly tax rate. If you earn more than 50,000, that means that if your monthly salary, let me just bring it to old currency, if your monthly salary is more than 500 million and 400 and what, then you are going to pay 35%. All right. Now, other notifications or other things that you should be taking note of. Yeah, Felix.
Sir, please, what?
Yeah.
Please, can you go back to your last slide?
All right.
Yes, sir. Can you please talk briefly on the cumulative tax?
All right. So what I'm saying is the cumulative tax is the total tax here. So when you add everything here, you'll be getting this one. Now that means that in a month, if you earn 490 cedis, you don't pay any tax. So your tax is zero, your cumulative tax is zero. But if your tax is an additional 110 cedis, 490 plus 110 is going to be 600 Ghana, right? Yeah, I think 600 Ghana. That means that if you earn 600 cedis in a month, your first 490 is not
Hello,
going
sir.
to be
Your first.
Yeah,
Hands up now.
Felix.
Yeah,
Felix.
Yes, I'm online now. The
Yeah,
tax,
I can hear you.
reduction from the monthly income. And the last one, which is 27, which he said if in 5,416, your tax will be 35. The question I want to ask is that with the 5,000, would they start deducting the 490, 110, and then when you now read that it exceeds that will be that, or they just collect the whole amount? That
Oh no. They are going to do it 490, 110, 130, everything. And then if they reach your 30,520 and they realize that you still have a lot of amount left, that is where the 35 comes in. So they will deduct from 490, 110, 130, 3166, 16,000, 30,000. Now, when you add all of this, you are getting a 50,000 here. That means that if they reach the next 30,520 and they realize that there's still an excess, then that means that you are earning more than 50,000. And all the 50,000 is not going to be charged 35%. Only the excess of it is going to be charged by 35,000.
Okay, thank you, sir.
All right. So the one who asked the question about the cumulative tax, it is just an addition of the tax. So at every point, if you want to know the cumulative tax, you add and add and add. Now, with this, let me explain something. With this one, that means that if you earn 600,000, you pay tax of only 5 cedis, 5.5 Ghana cedis. Now, what happens if you are earning 500 cedis? If you are earning 500 cedis, then it means that the first 490 is not subject to tax. The next 10 cedis will be charged at 5%. So the next means that if it falls within that, that doesn't mean that if you earn more than 490, it is going to be automatically 110. That means that if you earn 500 Ghana cedis, your first 490 is not charged tax, but your next 10 cedis is going to be charged 5%. So 5% of 10 cedis, I think, is going to be 5% of, I think, going to be what, 50% or so, right? 5% of 10 cedis, yeah, 50%. So that means that if you earn 500 cedis in a month, your tax is going to be 50%. That's what it means. So it means that if you have 500 cedis for the whole year, your tax is going to be 50% times 12, which is going to be, I think, 12 cedis. Yeah, you're just going to pay 12 cedis as tax. Wait. No, I think it's going to be 6 cedis. So 50% times 12, 5 to 60. Yeah, 6 cedis. You're just going to pay 6 cedis tax. Yeah. So if you are an employee and then your final salary is 500 cedis, you just pay 6 cedis for the whole year. It's better because the one who is earning lower is paying a very low amount. And if you are earning bigger, you are being charged a bigger amount. All right.
So please, sir. Please, sir.
All right. Yeah.
So
Yeah,
let's assume that someone is paying a cumulative tax of 6 cedis. Can that person file for a claim of child education relief?
You see, this is the taxable amount. Please can you mute yourself? I'm getting feedback. Dana, can you please mute yourself? All right, thank you. So this is all right. Thank you. So this 490 cedis, is the final basics, the final accessible income. So that would mean that, let's say your salary is 400 cedis. Now they add additional benefits of 100 cedis, you get to 500 cedis. Now you have a child and everything, they deduct the reliefs and everything, and at the end you are getting to pay 500 cedis. So it means that this is not the basic salary. This is the chargeable income. Is it affecting chargeable income here? At the end, so after adding your basic salary, all your benefits, and deducting your reliefs and your deductibles, if the amount is 490, then we are saying that you don't pay any tax. That's what it means. Then is it clear?
So what I'm saying is that like assuming I'm paying a tax for the whole year, my tax is 6 Ghana cedis. Am I supposed to apply for a child education relief?
All right. So the child education relief should be applied before you pay your amount. I don't know if you get it. Your child education relief should be applied to and be given to you before we even arrive at the end.
Oh, okay, sir.
You get it. But definitely, if your accountant
cut
does
in.
not,
Sorry to cut in. So maybe if I understood Emmanuel or whoever, so with that element of component of tax being paid, are you eligible for that tax relief?
everyone is eligible for a tax relief. Jamila, I've seen it. I'm coming. Everyone is eligible for tax relief.
I think my colleagues are they are just mixing up a whole lot of things. I think that the tax you get at the end of the day doesn't determine the relief that you get. Relief is a separate thing from the tax. I think they are not getting both clearly. That's what I'm thinking. Maybe they should get to know.
Not that we are not getting. Please, madam. Not that we are not getting. No. The thing is that like on the relief aspect, they said a child is like 600 cedis.
Yes.
And now somebody is pay, and now somebody total tax is 6 cedis in a year.
Okay.
We now want to know whether that person can apply for that claim.
The tax is not related to the relief. The relief will be added to your deductions and then your benefits. It will be added before the tax will be computed.
All right.
Hello.
So
I thought the relief will be added before your tax will be computed.
Jamila, let me just give you my answer. I think because you are close together, I'm getting feedback, but I hope we all get everything that we are saying. All right. So let's assume, we are going to assume that your salary is 500 cedis, your basic salary. So if you have a pen and a paper, I can write it, and your basic salary is 500 cedis. 500 cedis. Now you get a cash allowance. Please, let's meet ourselves. You get a cash allowance of 200 cedis. That means that your total cash emolument and everything, let's say you don't get any other benefit again, is 700 cedis. Are we following? Let's say all you receive from your employer is a basic salary of 500 cedis and then an allowance of 200 cedis. So you just get 700 cedis at the end of the month, right? Now, you have a child. The child that you have, your child is going to school. Now, the child is going to school, and we are saying that the child going to school earns 600 cedis. Now, this is an annual amount. So if we are calculating monthly amount, then the child relief is going to be 50 cedis. Let's say you have only one child. So 50 cedis for the relief. Moving on, let's say you are also, you also have a wife. And your wife is dependent on you. So the marriage responsibility allowance is also 150 cedis. It's 120 cedis. So 100 cedis. Because when you go back, I said the child education is 600 cedis. Divided by 12 is 50 cedis. The marriage allowance is 1,002 divided by 12 is 100 cedis. We are calculating it based on monthly basis. So the total reliefs that are to be charged is how much? 150 cedis. Please, are you following? So 700
Yes,
minus
we are
150.
following.
So 700 minus 150 is going to give us what? 550. Are we following?
Yes, please.
Yes, we are following.
Now after the relief, let's say in that month you made a charitable donation of 50 cedis. Now you have 500 cedis left. Please, when we answer, let's meet ourselves. You have 500 cedis left. So the first 490 cedis is not going to be taxed. It's zero. And then the 10 cedis is going to be taxed at 5%, which is going to be what? 50 pesos. So your salary or your taxation for that month is what? 50 pesos. Now let's make it annual to make it understandable better. So your basic salary is 500 cedis per month. That means that at the end of the year, 512 is what? 6,000. Your basic salary is 6,000. Moving on, you get an allowance of 200 cedis per month. 212 is going to be what? 2,400. So at the end, you are getting 8,400. I hope we have calculators and we are flowing. So at the end, your total cash emolument is what? 8,400 for the year. I'm using the same example. Now you have a child. The child is going to school. So you are going to be charging what? 600 cedis. So that relief is going to be 600 cedis to be deducted. You are married. Your spouse is dependent on you. You are going to deduct 1,200. So let's give it to me. 8,400 minus 600 minus 1,002. What are we getting?
600.
6,600.
600.
Thank you very much. Now the donation that you make, the charitable donation, let's say you make the 50 cedis every month. That means at the end of the year, it is going to be what? 600. Is that following? So 6,600 minus 600 is going to be what? 6,000. Now let's go back to the yearly charge of taxation. So the yearly charge of the taxation, we are saying that the first amount of 5,880 is nil. So 6,000 minus 5,880. What are we getting?
$120.
We are getting what?
That'll be 200. Let me see.
Thank you very much. So 6,000 minus 5,800. So we are getting what? 200.
So we are getting what? 200.
180.
Now the 200. Sorry, it's 180, not 200. Wait. 6,000 minus 5,800. Let me do the calculation myself. You are confusing me. We have 6,000 minus 5,800. We are getting 200. Now we are saying that 5% of that 200 is going to be what? 5% of 200 is going to be what? What are we getting?
Say 10.
10.
Yes, sir.
No, I don't think.
200
right.
5%. To give you 10.
It's 10.
It's 10, right? All right, 10 cedis. No, then it means that there's something wrong somewhere. Because when we divide the 10, we should be getting the same thing.
The deduction should be 5,880.
Yeah, 5,880. So we have
We deducted
6,000.
5,800 rather.
Yes. So it is 120. Yes, thank you very much.
20.
So 120. So 5% of 120 is going to be what? Thank you very much. 5% of 120 is going to be
The
what?
6.
6 cities, right?
Yes.
That means that whether you are charging it per month or per year, you are going to be getting the same thing. So 50 pesos per month for 12 months is going to be what? 6 cities. That means that if your annual salary is 6,000, they are going to be paying 6 cities. So the question about can you claim this one after the 6 cities is not applicable here. We are saying that you claim it before your taxable income is applied to the rates. I don't know if this has made it clearer to you. Those who are confused. So you claim all of the deductibles, all of the reliefs before you come and get your taxable income, before the rates is applied to it. And at that time, you've already claimed everything that you are supposed to claim. So those who are confused, any further confusion, or you understand?
No, please, we were not confused. So we wanted to know.
Okay. So when we have an example, you'd understand. But for the time being, know that all the reliefs will be deducted from your cash and benefit. Everything will be deducted before you get to your final amount, before the tax rate will be applied to it. So after the tax rate has been applied to it, you don't have to worry about whether you have to deduct any relief. All right. So lastly, let's just go to other rates, other considerations. Now, if you are a non-resident, then your tax is flat at 25%. So at the end, they just start 25%, and we are done with you. Also, when it comes to gifts from other sources of income, you can elect to charge 25% on it. So when it comes to gifts, you can elect to treat it differently and charge 25% flat tax on it. Also, when you have any gains from realization of investment properties, you can also elect to differentiate it and charge 25% on it. All right, so any questions? We have 4 minutes. If you have any questions, let's address it before we close. Tomorrow, then we will deal with the income from business. So this is income from when you are being employed by someone else. Tomorrow we'll be dealing with income from when we are doing our own business. Any questions?
Yes, sir. Hello, sir.
Sorry. Steven.
Yeah, I wanted to find out in our motors when you look at unit 3, like a lot of calculation involved. By our slash, that was just about only reading. I don't know. That one it will not affect us in the
worry.
exams.
When we are done, you see, when it comes to accounting, people think it's only calculation. But when you go down, you realize that it is a combination of reading and calculation. If you don't read the applicable laws or the applicable standards applying to it, when you get there, you will not know how to apply it. So this is the theory aspect. I want you to know that in taxation, these are the things that you will see there. After we are done, there will be a tutorial session where we calculate.
Okay. Yeah. Thank you, sir.
All right. So know that this is, or else if you don't know what is supposed to be there, you would see it and you would even ignore it. So now that you know that, definitely, if you are married and your spouse depends on you, there's an allowance. If your children go to school, there's an allowance. If you contribute to charity, there's an allowance. So now that you know all of these things, then we are saying that, all right, now we will transfer it to the calculation. So don't worry, we will do calculations on both employment income and business income. We'll do it on both of them. But at this moment, I want you to just know what it entails. All right. Any other questions or concerns?
Sir,
Yeah.
So, yes, sir, please, I want to ask a question about the relief. So let's take it for
All right.
instance. I have 3 kids. So when will my relief be over? Like when will my relief stop? Am I going to will they relieve me till the children grow up to a certain age or so?
It is a children education relief. That means that if you stop taking care of your children's education by means
Okay.
of they completing or by means of they now getting money to take care of themselves, then you cannot claim it again.
Okay. Yes, sir.
So in Ghana here,
So thank you.
usually, all right, in Ghana here, usually our children or our parents usually take care of us until we complete our first degree. But sometimes, if your parents are not paying your first degree fees, if you are the one working to pay your first degree fees, then your parents cannot claim education relief on you because they're not the ones paying your fees at that moment. All right, any other? All right, so I would be sending these notes, and then the notes are a lot, but I found a KPMG analysis of all of them. I found a KPMG analysis of all of them. So I would be sending all of that into the group. So I'll be sending this into the group so that you get to understand this. Now, I'm taking it again. The books that you have, they are a little updated and they've included some additional notes from Unit 3 to Unit 6 on the Google Drive. I would want you to go and then read them. I place it on the group. I'm going to place it on the group again. So Unit 3, Unit 4, Unit 5, Unit 6. I'm going to reshare it on the group. The principles usually remain the same. But
Please,
generally,
sir.
what changes are the rates and how to address them.
Sir,
Please, sir.
All right. I'm listening.
Yeah, please. Some of us are not part of the group, oh, so some of us are not part of the group.
So
The link is there.
check.
The link is there.
The link has been placed. The link has been placed in the in-call messages. So just click on it and join. Go to the in-call messages. It has been placed there. Just click on it and join. All right. Any other concerns? Now, if you know of any colleague who is not part of
Sir,
it,
tomorrow, what time are we joining?
he said
Tomorrow,
tomorrow
what
12
time are we
o'clock
having
to
a
12:30
PM?
to 1:30. 12:30 to 1:30.
Oh, okay.
Tomorrow 12:30 to 1:30.
yeah, the way they're increasing the rent. I said she
Tomorrow
didn't get the
1:30
one
to
is from
12:30.
rent control. Now. I don't know where he gets sleeping here. Ah, no, well, well, my own
All
this
right.
it
Any
was
other
sometime last year.
concerns? Any other concerns? So I've already placed the book. So if you have the book, if you want, you can print the Unit 3, Unit 4, Unit 5, or Unit 6. You can print it and then you can just study it alongside it because those are the additions by code. Like I said, as of last year, some things have also been modified again. So in my notes or in my slides, you will see the modified things. That's all. The difference is just the rates, the amount, and how to treat things. But the principles and most things, all of them remain the same. All right, any other concerns? Any other concerns? So if there are no concerns, I'll end the class here. Go all in tomorrow at 12 minutes.
Hello, sir. Hello, sir.
Yeah, me, I'm not here. What's up? I'm busy something. What's up?
Sir, please, are we done?
Oh, we are done. Yeah, Pong.
Okay, sir. Okay, sir.
All right.
And sir, please, about the groupings.
Yeah, we'll communicate on the page. We'll communicate on the page. We'll communicate on the page. Just make sure that everyone is on the group. So if you don't have any colleague, just from them that they should join the group.
Okay, sir.
All right.
Hello, please. Is a class rep here, please? The course rep.